Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Papa JOHNS International Inc. quarterly report. Papa John's International, Inc. offers a variety of businesses and services including pizza delivery and carry-out restaurants, dine-in and delivery restaurants. Internationally, food and beverage products supplies such as plus pizza sauce, plus dough, plus paper products, plus smallware, plus cleaning supplies. Papa John's International Inc. stock price has dropped significantly in the past year due to several key events. The most impactful was Apollo Global Management's withdrawal of its offer to take the company private for $64 per share, causing a nearly 20% drop in shares. Additionally, disappointing Q3 earnings announcements in both 2024 and 2025 led to stock price declines, with adjusted EPS falling short of expectations by as much as 21.95%. Furthermore, BofA Securities downgraded Papa John's stock rating from buy to neutral, lowering its price target by nearly 20%, contributing to the decline in shares. These events have cumulatively led to a minus 19.49% drop in Papa John's stock price over the past year. The primary drivers of revenue growth and decline can be summarized as follows. Revenue growth drivers: franchise royalties and fees, commissary revenues, and advertising funds revenue contributed significantly to revenue growth. The company's development strategy, including opening 45 new restaurants, also drove growth. Additionally, higher allocation of corporate expenses to the North America franchising and international segments, PJMF contributions from domestic restaurants, and sublease income all contributed to revenue growth. Revenue decline drivers. The primary drivers of revenue decline were decreases in company-owned restaurant sales, North America franchising segment decline due to higher incentive compensation, and comparable sales declines in both domestic company-owned restaurants and UK company-owned restaurants. Net income and profit margins decline in 2025. The financial performance of a company has taken a significant hit in 2025 compared to the previous year. Net income plummeted by $37.3 billion for the 3 months ended and $45.8 billion for the 9 months ended, resulting in net incomes of $4.5 billion and $23.5 billion respectively. Profit margins also suffered a substantial decline, with a drop from 8.28% to 0.88% for the 3 months ended and from 4.53% to 1.51% for the 9 months ended. The main reasons behind this decline include higher effective tax rates, increased depreciation and amortization, refranchising and impairment loss, and inflationary pressures. Additionally, the company faced higher labor costs, increased commodity prices, reduced consumer spending, and increased costs for branding initiatives and launching new advertising and marketing campaigns. These factors collectively contributed to the decline in net income and profit margins in 2025. The company is indeed generating positive operating cash flow. This is evident from the financial summary, which highlights 4 key indicators of a healthy cash position. Firstly, the net cash provided by operating activities stands at $106,192, page 15, demonstrating a significant inflow of funds into the business. Secondly, operating cash flows from operating leases are increasing, indicating that the company is efficiently managing its lease obligations. Furthermore, the change in cash and cash equivalents is positive at $1,017, page 60, signifying that the company's cash reserves are growing. Lastly, both years' net cash provided by operating activities are listed as positive on page 62, reinforcing the notion of a stable and improving financial situation. Overall, these indicators collectively suggest that the company is generating sufficient cash to meet its operational needs, thereby confirming its ability to produce positive operating cash flow. The company's debt level and interest expenses have undergone significant changes. Notably, long-term debt decreased by $19.6 million from December 2024 to September 2025. However, the outstanding debt as of September 2025 was $736.7 million, with no comparison provided for previous periods. Interest expenses also fluctuated, with a decrease of minus $9,945 in the 3 months ended September 2025, and a total decrease of $1,980,000 year-to-date. Conversely, interest expenses increased significantly on page 27, while decreasing significantly on page 29. The liability for interest rate swaps increased from $161,000 to $770,000. Overall, the data suggests that the company's debt level and interest expenses have changed significantly in some areas, but not consistently across all periods. The company's financial summary reveals a mixed performance across its segments and regions. On the positive side, North America franchising and international operations showed strong revenue growth, with international franchise restaurant sales experiencing 10% growth over 3 months. Additionally, franchise royalties and fees, as well as other revenues, saw significant increases of 2.7–12.2%. However, domestic company-owned restaurants struggled with negative EBITDA adjustments due to high expenses, while UK company-owned restaurants experienced a decline in revenue of $19.4 million. Despite expected improvements from supply chain savings and refranchising efforts, these segments continue to underperform. Management is optimistic about the company's outlook despite a challenging consumer environment. Key strategies include improving profitability through strategic restaurant closures and divestitures, focusing on marketing, digital, and loyalty initiatives to drive long-term success, achieving $50 million in supply chain savings by 2026 through productivity initiatives, accelerating domestic refranchising program over the next 2 years, investing for growth while maintaining a strong balance sheet and returning value to shareholders. Management is also taking steps to offset higher costs due to inflationary pressures, including menu price increases and expense control measures. The company has a history of paying dividends to its shareholders. In 2024 and 2025, it paid out $45.4 million and $45.8 million respectively in cash dividends. This indicates that the company prioritizes returning value to its investors through dividend payments. On the other hand, the company's share buyback activity is less clear-cut. While page 60 mentions share repurchases, subsequent pages contradict this statement, indicating no actual share repurchase activity took place in either 2024 or 2025. Supply chain concerns loom large for the company. The company's financial summary highlights a pressing concern: potential supply chain disruption. This issue has already led to significant losses on equipment disposal due to challenges in 2025, page 45. Furthermore, previous COVID-era programs have also been impacted by supply chain issues, resulting in additional losses, pages 54 and 59. The risk of supply chain disruption is not limited to external factors such as weather or natural disasters. Geopolitical events and other unforeseen circumstances could also impact the company's operations, page 64. These concerns underscore the need for the company to develop strategies to mitigate potential disruptions and ensure a stable supply chain. That concludes the financial summary for Papa JOHNS International Inc. Feel free to comment below, and I will be happy to answer them when possible.